The market does not move the way most people think it does. Price does not move because of indicators. It does not move because of trend lines. It does not move because you placed a trade. Price moves because of human behavior under pressure. And once you understand that, price action stops being mysterious. It becomes psychological. Most traders look at charts and see patterns. Professionals look at charts and see people. Fear, greed, hope, regret, panic, euphoria. Every candle is a footprint of emotion. Price action is not technical analysis. It is crowd psychology made visible. Think about real life for a moment. Imagine a crowded room where someone suddenly shouts, "Fire." No one stops to analyze the situation calmly. People react. Some freeze. Some run. Some push. Some follow the crowd without thinking. The market behaves the same way. News breakouts, fake moves, sudden reversals. These are not random. They are emotional reactions playing out at scale. Most traders think the market is hunting their stop losses. It's not. The market doesn't know you exist, but it does know where fear clusters. And fear clusters at obvious places. That is the first dark truth. Support and resistance work not because they are magical lines, but because humans remember pain. If price fell hard from a level before, people remember it. If price exploded upward from a level before, people remember it. Memory creates behavior. Behavior creates price movement. Life works the same way. If you touch a hot stove once, you hesitate the next time. If you crash your car at a certain intersection, you slow down there forever. The market remembers pain, and traders react to memory. This is why price often hesitates, stalls, or violently reverses at old levels. Not because of lines, but because of collective trauma. Legendary trader Mark Douglas explained this clearly when he said that the market is a neutral environment, but traders are not. They bring fear, expectation, and ego into every decision. Price action is simply the result. Now think about breakouts. Most beginners love breakouts. They see price moving fast and feel excitement. But ask yourself this: who is buying at the top of a breakout? Usually people who were afraid to enter earlier, people who waited for confirmation, people who didn't want to be wrong. That means breakouts are often driven by late fear, not confidence. And fear-driven buying is weak. This is why many breakouts fail. Not because breakouts don't work, but because of who is entering them. Professionals understand this. They don't ask, "Is this breaking out?" They ask, "Who is trapped here?" Trapped traders are fuel. That is dark psychology. Consider real life again. Imagine a store announces limited stock. People rush in, not because they need the product, but because they fear missing out. That fear pushes price up. But once the urgency fades, demand disappears. Markets behave exactly the same. FOMO creates bad entries. Bad entries create trapped traders. Trapped traders create reversals. This is why price action often looks cruel. It is not cruel. It is indifferent. Another uncomfortable truth. Most price action patterns work because most people use them incorrectly. Retail traders see a head and shoulders and sell immediately. Professionals wait. They wait for confirmation of failure because failure creates emotion, and emotion creates movement. Paul Tudor Jones once said that the most important thing in trading is defense. He didn't say prediction, he said defense. Why? Because price action is not about being right. It's about surviving human irrationality. Look at how people behave after losses. In life, when someone loses money, they want it back fast. They take risks they normally wouldn't. They make emotional decisions. The market exploits this instinct relentlessly. After a sharp move, traders chase. After a loss, traders revenge trade. After a win, traders overconfidence trade. Price action is the market's way of redistributing money from emotional hands to disciplined ones. This is not theory, this is observation. Legendary trader Jesse Livermore said the market is never wrong, but opinions often are. What he meant was simple. Reality doesn't care about what you think should happen. Price only reflects what people are actually doing. Now think about consolidations. Most traders hate sideways markets. They get bored. They force trades. But consolidation is where psychology builds pressure. It's where traders grow impatient. It's where breakout traders prepare. It's where counter-trend traders wait. It's where uncertainty increases, and when uncertainty peaks, movement follows. Life teaches the same lesson. Pressure builds when decisions are delayed. Arguments escalate when things are left unresolved. Stress increases when clarity is missing. The market resolves emotional pressure through movement. That movement is price action. Now let's talk about stop losses. Stops represent admitted failure. They are emotional pain points. That's why so many traders hate them. But from a psychological perspective, stops are liquidity pools. Where many people feel pain together, action happens. This is why price often spikes into stops and reverses, not because the market is evil, but because fear creates volume. Professional traders understand that panic sells faster than logic. They don't fear stop hunts. They expect them. Life example. Think about traffic jams. One person brakes suddenly. Fear spreads. Everyone brakes harder than necessary. Chaos follows. Markets behave the same way. Small moves trigger fear. Fear triggers larger reactions. This is why volatility expands during uncertainty. Price action is amplified emotion. Mark Douglas said traders don't lose because they're wrong. They lose because they don't know how to think in probabilities. Price action is probabilistic psychology, not certainty. If you need certainty, price action will destroy you. Now consider false moves. False breakouts hurt the most. Why? Because they attack confidence. They make traders feel stupid. That emotional damage causes hesitation later. False moves are psychological weapons. They remove weak confidence. They punish impatience. They reward patience. In life, false promises do the same. You trust once. You get burned. You hesitate next time. The market trains traders emotionally. Either you adapt or you disappear. Another dark truth. Price often moves the most when it makes the least sense. This is not random. It's because the majority positions themselves based on logic, and markets move based on imbalance. When too many people agree, risk is one-sided. When risk is one-sided, reversals are violent. That's why obvious trades are dangerous. That's why crowded trades collapse. Warren Buffett famously said to be fearful when others are greedy, and greedy when others are fearful. That is pure price action psychology. Greed and fear leave footprints, and those footprints are visible on the chart. The problem is most traders look at charts emotionally. They project hope onto bullish candles. They project fear onto bearish candles. Professionals observe without attachment. They don't fall in love with a bias. They don't argue with price. They listen. Life teaches this lesson painfully. People who argue with reality suffer more than those who adapt to it. Price action rewards adaptation. Now consider time. Price action is not just where price is, it's how long it stays there. Time creates belief. If price stays at a level long enough, people trust it. Trust leads to size. Size leads to vulnerability. And vulnerability creates opportunity. That's why long consolidations often lead to explosive moves. Not because of magic, but because belief becomes crowded. Crowds are fragile, always. This applies to markets, businesses, and societies. Crowds collapse faster than individuals. Price action exposes crowd weakness. One final truth. The market is not designed to hurt you, but it will punish emotional behavior without mercy. If you chase, it exhausts you. If you hope, it drains you. If you fight, it breaks you. But if you observe, if you wait, if you manage risk, it becomes surprisingly fair. Price action is not dark because it is evil. It is dark because it reveals truth. It reveals who is patient, who is emotional, who is disciplined, who is desperate. And in the end, price does not move against you. It moves through you. Your reactions determine whether you survive it. This is the dark psychology behind price action. And once you see it, you can never unsee it. Once you see price as behavior, you start noticing something unsettling. The market does not reward intelligence first. It rewards emotional neutrality. Many intelligent people fail at trading because intelligence often comes with ego, and ego is the most expensive emotion in the market. In life, ego makes people argue instead of listen. It makes them defend bad decisions instead of correcting them. It makes them stay in situations long after they should have walked away. The market exploits ego mercilessly. When price moves against you, the first instinct is not logic. It is self-defense. This setup is still valid. It will come back. The market is wrong. Price action doesn't care. Every extra candle against your position is a psychological negotiation between reality and denial. And denial always loses. This is why losing traders widen stops. Not because it's strategic, but because they are emotionally unable to accept being wrong. Accepting loss feels like admitting weakness, but in reality, refusing loss is the real weakness. Legendary trader Ed Seykota once said that everyone gets what they want from the market. Some people want excitement, some want validation, some want to avoid responsibility, and the market gives it to them at a cost. Price action reveals what you are unconsciously seeking. If you seek action, the market gives chaos. If you seek certainty, the market gives confusion. If you seek control, the market gives humility. Another dark layer of price action is time-based pain. Most traders assume pain comes from losing money. It doesn't. Pain comes from waiting while being wrong. In life, waiting is emotionally exhausting. Waiting for a message, waiting for results, waiting for change. The longer uncertainty lasts, the more stress it creates. Markets use time as a weapon. Price will often move sideways just long enough to break patience. It drains confidence without moving anywhere. Traders start questioning their analysis. They start forcing trades. They start abandoning plans. Then, when discipline is weakest, price moves. This is not coincidence. This is psychological timing. Professionals understand that boredom is more dangerous than fear. Fear makes people exit. Boredom makes people do stupid things. Price action thrives on boredom. Another truth most traders never accept: liquidity is emotional. People think liquidity is technical volume. It's not. Liquidity appears where people feel forced to act, forced exits, forced entries, forced decisions. That force is emotional pressure. Stop losses are forced exits. Margin calls are forced exits. Breakouts create forced entries. This is why large players operate around emotional extremes. Not because they are manipulating individuals, but because crowds behave predictably under pressure. Life experience proves this. When people are calm, they negotiate. When people are stressed, they react. Markets are always searching for reaction. Now consider why price often spikes violently during news. It's not because news is powerful, it's because news removes hesitation. Uncertainty disappears. Decisions become immediate. Fear accelerates. Price action feeds on urgency. This is why many professionals reduce risk during news, not because they fear volatility, but because volatility is uncontrolled psychology. Another uncomfortable truth. Most retail traders try to trade outcomes. Professionals trade behavior. Retail asks, where will price go? Professionals ask, who will panic next? This shift changes everything. Think about a crowded elevator that stops suddenly. No one asks why immediately. They feel fear first. The market works the same way. Emotion always leads. Logic follows later, usually too late. This is why price action often overshoots. Fear doesn't stop at fair value. Greed doesn't stop at reasonable targets. Extremes are emotional, not logical. Legendary trader George Soros talked about reflexivity, the idea that perception shapes reality. In markets, belief creates action. Action creates price. Price reinforces belief. This feedback loop continues until it breaks violently. Price action is the visual record of this loop, and when it breaks hard. Now consider why traders struggle with consistency. Consistency requires emotional stability, but most people bring life stress into trading. Bills, ego, comparison, pressure to succeed. The market becomes a mirror. If you are impatient in life, you are impatient in trading. If you avoid responsibility in life, you avoid stops. If you seek validation in life, you overtrade. Price action exposes personal flaws. This is why trading feels personal, even though it's not. The market doesn't attack you, it reflects you. That reflection is uncomfortable. So people blame manipulation. Manipulation is easier to accept than self-awareness. Another dark layer. Hope is more dangerous than fear. Fear makes people exit. Hope makes people stay. Hope convinces traders to hold losers and cut winners. Hope whispers, just give it time. But time without structure is decay. In life, hope without action leads to stagnation. In trading, hope without risk control leads to ruin. Price action punishes hope relentlessly. This is why strong trends feel easy after they're obvious. Because hope is gone. Only acceptance remains. And acceptance creates clarity. Now consider why price respects certain levels with surgical precision. It's not technical, it's psychological anchoring. High humans anchor, meaning to numbers. Round numbers, highs, lows. These numbers become emotional reference points. That's why reactions happen there. Not because of math, but because of memory and meaning. Legendary traders don't worship levels. They observe reactions. Reaction is emotion. Emotion is truth. One final deep truth. The market is not a place to prove intelligence. It is a place to practice emotional restraint. Those who try to dominate price action lose. Those who listen to it survive. Price action doesn't reward speed. It rewards patience. It doesn't reward certainty. It rewards adaptability. And it doesn't reward prediction. It rewards humility. Once you truly understand this, trading stops being a fight. It becomes observation. And observation removes fear. Because fear thrives in misunderstanding. This is the deeper, darker psychology behind price action. Not manipulation, not conspiracy, not secrets. Just human behavior under pressure, repeated endlessly. And the moment you stop reacting emotionally, price action stops feeling dark. It becomes honest. And honesty is the most powerful edge you can ever have. When traders finally accept that price action is honest, something strange happens. They stop trying to win. And when you stop trying to win, you stop making desperate decisions. Desperation is visible on a chart. It shows up as chasing candles. It shows up as oversized positions. It shows up as moving stops and hoping. Price action punishes desperation faster than ignorance. In life, desperation changes behavior too. A desperate person speaks too much. They reveal intent. They make concessions too early. The market does the same. When traders are desperate, they reveal themselves through poor timing and emotional entries. That behavior creates opportunity for those who are calm. This is why patience is not passive in trading. Patience is predatory. You wait while others exhaust themselves. Price action is not a race. It is an endurance test. Most traders don't fail because they lack skill. They fail because they cannot sit still while uncertainty exists. Stillness feels unsafe to the human brain. The brain wants resolution. The market weaponizes that instinct. Another uncomfortable layer of dark psychology is self-sabotage. Many traders don't actually believe they deserve consistent success. So when things go well, they unconsciously break their own rules. They overtrade after wins. They increase size too quickly. They stop respecting risk. In life, people do this too. They ruin good relationships. They sabotage progress. They return to familiar pain instead of unfamiliar stability. The market exposes this pattern brutally. Price action doesn't just test your strategy, it tests your identity. Who you believe you are determines how you behave under pressure. If you see yourself as someone who struggles, you will recreate struggle. If you see yourself as someone who survives, you will protect capital. This is why legendary traders speak more about mindset than setups. Not because setups don't matter, but because mindset decides whether setups are followed. Another dark truth. Most traders think they lose money in the market. In reality, they give it away. They give it away through impatience, through ego, through the need to be right. Price action does not steal. It waits. It waits until emotion overrides logic. Then it takes. This is why revenge trading feels inevitable after losses. Loss creates emotional imbalance. Imbalance demands correction. The brain seeks relief. Trading becomes therapy instead of execution. And therapy trading always ends badly. Life example. After a bad day, people eat junk food. They scroll mindlessly. They seek comfort. Traders do the same. They seek emotional relief through action. Price action punishes emotional action. Another layer many never see. The market teaches discipline through pain. Every painful loss carries information, but most traders ignore the lesson and repeat the behavior. Pain without reflection is wasted. Legendary traders review losses not to punish themselves, but to understand emotional decisions. Price action is feedback, and feedback ignored becomes punishment. Now consider why traders obsess over entries. Entries feel like control, but entries are the least important part of trading. Exits reveal psychology. Anyone can enter. Few can exit properly. In life, starting things is easy. Ending things correctly is hard. Relationships, jobs, habits. The market is no different. Price action tests exits relentlessly. Can you exit when you're wrong? Can you exit when you're right but uncertain? Can you exit without regret? Regret is another dark force. Regret convinces traders to re-enter bad trades. If only I held longer. If only I entered earlier. These thoughts distort future decisions. Price action thrives on regret. Regret keeps traders emotionally attached to past outcomes. Professionals stay present. They trade what is, not what was. Another hidden psychological layer is comparison. Social media destroyed many traders. They see profits posted by others. They feel behind. They force results. Comparison compresses time. It makes people rush development. In life, rushing growth leads to collapse. In trading, rushing mastery leads to blown accounts. Price action doesn't reward speed. It rewards repetition, slow, boring, controlled repetition. That's why professional trading looks boring, because boredom is stability. Excitement is instability. Now consider trends. Trends are not momentum. They are agreement. When enough participants agree on direction, price flows. But agreement is fragile. The moment doubt enters, volatility increases. This is why strong trends end violently. Confidence collapses suddenly. Life works the same way. Belief systems hold until they don't. Price action reflects belief collapse in real time. That's why reversals feel shocking. Shock is emotional reset. Another dark truth. Most traders try to predict reversals. Professionals wait for confirmation of failure. Failure is psychological. It's when attempts stop working, when breakouts fail repeatedly, when pullbacks no longer hold. That's not technical failure. That's confidence failure. Price action always breaks confidence before it breaks structure. Now think about drawdowns. Drawdowns are emotional erosion. They slowly drain belief. That's why many traders quit during drawdowns, not at account zero. They quit when hope disappears. Price action knows this. It stretches pain over time. This is why consistent risk is essential. Not for money, for psychology. Small losses preserve emotional stability. Large losses distort perception. Legendary trader Van Tharp emphasized that position sizing is the real edge. Because size controls emotion. Emotion controls behavior. Behavior controls outcome. Price action is downstream of size. Another final layer. The market doesn't reward perfection, it rewards resilience. You will never avoid losses, but you can avoid emotional collapse. The traders who survive are not fearless. They are emotionally regulated. They feel fear and act correctly anyway. That is the true dark mastery. Price action stops being intimidating when you stop seeking comfort. If you've listened this far, understand this. Most people never reach this point. They quit when the market becomes uncomfortable. They quit when truth replaces hope. You didn't, and that already separates you from the majority. This channel exists for traders who are done chasing shortcuts. For those who want control over their mind before control over the market. For those who understand that survival comes before profit. Mental Minds FX is not here to entertain you. It's here to sharpen you. If this changed the way you see price, if it made you uncomfortable in the right way, then you already know why you should be here. Subscribe, not for signals, not for hype, but for clarity, discipline, and psychological edge. Because the market doesn't reward noise. It rewards those who think clearly under pressure. And this channel is built for exactly that.